Please welcome the National Association of Realtors 2021 President, Charlie Oppler.
Hello, I'm Charlie Oppler, 2021 President of the National Association of Realtors. Welcome to the kickoff event of NAR's Policy Forum Series. Today, a person's zip code is often a better indicator of their life expectancy than their genetic code. That's the legacy of historic, systemic discrimination and segregation that lasted for generations in our country. Home ownership rates for African Americans and Latino Americans have lagged behind those of white Americans for decades. Today, Black-white home ownership disparity gap is at 30 percentage points. It's the same, if you think about it, when discrimination was legal. And we know discrimination still persists. We can't change the past, but we can study it, try to understand how the legacy of historic discrimination still limits opportunity today, and resolve to build a better future. That's the focus of today's program. Today, you'll hear from industry's top experts who are working towards that better future by looking at ways to expand home ownership among those who have been left behind. We all know that for most people, achieving home ownership depends on access to mortgage credit. But the credit bureaus that determine our credit score and our fate often exclude many common household expenditures, providing only a partial view of households' credit performance. That means credit scores may not be accurately measuring who's a good credit risk and really who's not. This can be and has a devastating effect on potential home buyers of color, younger people, and those with thin or non-existent credit scores. The people being left behind are those who have been shut out of home ownership throughout our history. Bringing equity to the credit evaluation process could be a major step towards closing that persistent home ownership gap. NAR is honored to host this event because for us, making home ownership accessible for all qualified buyers is an organization-wide key strategic priority. NAR recently commissioned new research to review major types of alternative data in credit scoring, including credit proxies, banking data, and non-financial personal data. We'll begin with a panel discussion between the two scholars who conducted this research, and I'm so glad they're able to join us today. Next, we'll convene a group of experts to help see the big picture by examining the broader environment around fair housing and the implications of access to credit, fair lending, and the effects of the pandemic. After our discussions, I hope you'll leave today with a fresh perspective on how we arrived here and a renewed commitment to repairing the wrongs from the past. It will take all of us, business, government, community groups, and all to close the gap and ensure the Fair Housing Act, which is over 50 years old, is more than words on a piece of paper. And as Americans, we certainly have a stake in this outcome. Now I'd like to introduce our moderator, the award-winning real estate journalist, Michelle Lerner. Ms. Lerner has written about real estate, personal finance, and business topics for more than 2 decades. She writes about residential and commercial real estate for the Washington Post, the Boston Globe, and numerous other publications, both national and international. Her work has been recognized by the National Association of Real Estate Editors and the Society of Professional Journalism. She's also the author of 2 books on home buying. Ladies and gentlemen, it's my honor and pleasure to welcome Michelle Lerner. Hi, Michelle.
Hi, Charlie. Thank you so much. Oh, well, thank you. And thanks for the really nice introduction. I'm impressed with that. I am excited about this panel. It's interesting work, and I really want to jump right in so our speakers have plenty of time to get into the topic. So I'm not going to give them the nice bio and intro that I received, unfortunately. I'm just going to give you your names because I want time for them to talk, but their bios can be found on the panel information. So please join me in welcoming our first two speakers who co-authored these research, Tipping the Scale, Will Alternative Data Promoter Impede Fair Lending Goals? Both have an extensive background researching credit and fair lending issues. So please welcome Vanessa Perry, a professor and associate dean at George Washington University, and Ann Schneer, president of A.B. Schneer Associates Consulting Firm. Welcome to both of you.
Yeah.
So Ann, let's jump in here with you first. Please tell us what motivated this project and who can benefit from it.
Well, Vanessa and I have been working on credit scoring for many years, going back to our days at Freddie Mac, who first introduced the FICO score to the mortgage evaluation process. We've also been, over the years, both together and separately, involved in a number of development of a number of alternative scores that try to use data not typically found in the consumer's credit file. And while there's been a lot of innovation and work in this area over the last 10 to 20 years, we believe that the rise of big data and the emergence of artificial intelligence has greatly expanded the potential for using these kinds of data. And as a result of that, and given the impact of an individual's credit score on the access to a wide variety of services, including housing, we thought it would be useful to develop a framework for examining the pros and cons of different kinds of alternative data that were reflected factors over and above their predictive power. And that's what we tried to do in this paper.
Great, thank you. So Vanessa, tell me about why policymakers and consumer advocates are concerned about the credit scoring models as they exist now.
Sure, happy to do so. And thank you so much, Michelle. Great question. So credit scores are really essential for individuals and households to be able to fully participate in the modern economy in various ways. You need a credit score for access to credit, mortgage credit in particular, other kinds of financial services. Credit scores determine how much consumers have to pay for many of these kinds of services, and even certain employment opportunities are tied to credit scores. So they're really very important. They really matter. Where unfortunately, however, because many people of color, Black and Latino individuals and households are less likely to use traditional lines of credit, they're more likely to fall into a category that we all call unscorable. So that turns out to be a significant proportion. 21% of Black households and 17% of Hispanic households, Latino households, approximately, are unscorable. If you add on to that, the fact that because members of these groups are more likely to experience financial disruptions and have fewer assets to liquidate when they need extra funds, then you add another 39% of Black households and another 27% of Latino households fall into a category that we would consider high risk, which is a score of less than 620. And so taken together, we're talking about huge swaths of these groups who are unable to either have a credit score or have access to a good credit score simply because the data that are used are limited. So what many credit scoring firms, other researchers have been experimenting with, as Ann has mentioned, for some years now, are alternative data sources that could be used to enhance or in lieu of these traditional lines of credit to try to expand these opportunities for a larger group of consumers.
Great. So thank you. And so tell us what kinds of data are being proposed for inclusion?
Well, we classified, there's a wide variety of data. We classified them into three broad categories. The first, which has been examined for a number of years, are credit proxies, what we call credit proxies. And that are things like the timely payment of rent, utilities, telecom bills, financial obligations that are not typically debt, but that represent ongoing financial implications. So that's one category. The second category is banking data. That is data from an individual's banking accounts or accounts. And that includes things like net inflows and outflows. It includes check writing, it includes account balances, and all of these, certainly savings have always been used as part of the mortgage process. There's now access to these kind of data is much more widely accessible than it has been in the past. So that's banking data. And the third, which could include a range of things, we've labeled non-financial personal data. And this could include anything that's been harvested from the consumer's digital footprint. It could include Facebook's likes, dislikes. It could be used cell phone use. But that's the third category we look at. And we did these three groups because there's evidence that all these three kinds of data are potentially predictive of credit risk.
Interesting. Okay, thank you. So Vanessa, how should modelers determine whether to include certain data, what type of data?
So what we've done in this paper is to present a framework that we've devised that answers exactly that question. You know, what should we take into consideration as we evaluate the potential for these different categories of alternative data? And the framework creates a sort of nifty acronym that will hopefully help people remember, called SCALE, and it represents 5 factors. So these factors are based on some of the prior work that both Ann and I have done about with respect to alternatives to existing credit scores. And then we also spent some time looking at the literature on ethics and artificial intelligence, which has looked quite a bit at the ethics of algorithms. And so the SCALE framework is as follows. The S stands for societal values. And the question there is, including the data element, does the factor align with our current social and societal priorities, like our values of diversity and inclusion and social justice? The C stands for contextual integrity. This is one of my favorites, because just because a factor is predictive, it doesn't necessarily mean that it has construct validity. That is it really relevant, or is it just spurious? My favorite example there is, it could be the case, we don't know, but it could be the case that the number of bottles of wine purchased per month are predictive of, credit risk. That may be true, but that's really out of context. It's not relevant, and as a result, inappropriate. The A stands for accuracy. And the question there is, does including this particular factor, does it accurately reflect the financial situation of the households and households across the board? That's important. And is the data going to be widely available for households across the board? The L stands for legality. And one issue there is, does including the factor have a potentially negative or disparate impact on certain groups? If that is the case, is there a legitimate business justification for this disparate impact? And are there alternatives that could be considered that would be a better option? And then last but not least, the E stands for expanded opportunity. And the question is, does the factor actually expand the access to credit scoring significantly? Does it increase the pool of qualified borrowers? And hopefully, will it do so in a way that doesn't just increase the size of the pool of people who have higher risk scores, because that's an issue also.
Thank you. So Anne, if you could explain what the pros and cons are of the various types of data based on your framework.
Well, we, in our paper, developed a pretty simplistic way of just trying to rate the different 3 types of data categories, according to this framework. And we use the sort of traffic light analogy. Green means that the data appears to be fully compliant, great, full speed ahead. Yellow means there could be issues that deserve further thought and analysis. It also means we simply don't know. Some of the yellows in this chart, there just, to our knowledge, have been no studies that have looked at it. And the red, not surprisingly, a stop, likely violates a criteria. Be very careful about its use and either do it carefully or prohibit it. And I want to say at the beginning, these are all factors in addition to predictability. So it's over and above predictability. And it also, we want to say that just because we've rated, or you might rate a particular, give a particular type of data a red or a yellow, doesn't necessarily mean that it shouldn't be used. But it's just a way of applying this framework in a very visual sense to some of the policy decisions and considerations that we believe should be had. So I won't go through this chart in detail, but let me just sort of summarize what we found. If you look at what we call credit proxies, which again includes sort of regular payments on recurring financial obligations, these variables have long been recognized as a way of expanding access to credit. There are a number of studies that showed it would increase the number of people that would qualify for a mortgage. So they score high, but the problem is their collection is problematic. If you look, for example, at utility data, it's rarely routinely reported to credit bureaus. There are some proprietary data sets that exist on various kinds of utility payments, but they're typically marketed separately and used to construct very specialized credit scores. So again, most of the general credit scores use it when it's available, but it's seldom available. And rental data is another obviously important one. But the collection there is very problematic due to the diverse ownership of the rental stock and the burdens that FCRA imposes on people who report to credit bureaus. There have been attempts to create these apps. There are a number of apps in the marketplace where providers try to serve as a middleman between a landlord, the tenant, the landlord, and the credit bureaus. But for the most part, they haven't been used all that much. And I mean, just as final, there have been a couple of proposals in Congress to try to encourage the reporting of this kind of data, but they have yet to exempt state and local laws, which sometimes prohibit utilities company from even, giving these data out. So that is, again, sort of lots of support for this, difficult to implement. The second is what we call aggregated banking data. And that's probably the most promising of all the sources. Banking data has already been used by the fintech industry, which has facilitated the creation of these a few large-scale data aggregators, such as Finicity or Plaid, that basically partner with banks to facilitate the accessing this data. But unlike credit data, its use requires the express permission of the consumer. It's called consumer permission data in general. But it also requires the consumer to, once it uses the app, to basically explicitly tell the app to stop its collection. So most banking data, again, scores really high on our scale index. We found that one of our speakers today has conducted research that looked at how cash flows could be used as a better measure of credit risk. That brings a lot of unscorable people scorable. So that at a minimum also gives another way of measuring capacity, which is another part of the mortgage underwriting process. But if you also consider banking data, it could also be used to look at the payment of some recurring bills. And in fact, Experian Boost is a product out there that basically takes banking data, adds it to a consumer's credit score, but banking data for the payment of utilities, streaming services, and cell phone use, not rent. But that's a product out there in the market today. Just in closing, the fact that these special things are currently coming through does not mean they're necessarily going to be used. The other thing we want to point out on the banking data is, so these broad measures seem very promising. You can also see how banking data could be misused, not only from a privacy perspective, but if you begin to look at detailed expenditure data, going back to Vanessa's analogy of liquor store, a checking could be problematic. So that's why we have a few on what we call other transactions that are sort of red flags. I want to say another one of our speakers is from the OCC's Project Reach, which he'll tell you about, but it's currently looking at banking data and the potential use of banking data. And I think depending on the outcome of that initiative, it could really accelerate its use. The last, there's a lot written. We cover a lot in our paper, but the whole use of non-financial personal data. It covers a variety of data that could be harvested from the consumer's digital footprint, ranging from your spending patterns to your likes and dislikes, to your Facebook friends, to your cell phone use. And in fact, a number of these have been shown to be predictive, such as your web address, your email address. If people who use their full names are apparently less likely to default than those that disguise their names. In some countries, in underdeveloped countries with no credit bureaus, they're actually now using this kind of data, mainly on cell phone use, like what time you apply for a loan, how you use your cell phone to predict credit risk. But to date, its use in the United States has been relatively rare. And as you could see from the red, as you look at this category, we think most of this scores relatively low according to these criteria, even though they might be predictive.
Thank you so much. We've only got about 5 more minutes or so in this panel. I can't believe there's so much more to talk about, but Vanessa, I'm going to turn to you for a minute and just ask you if you could kind of say a little bit more about why, 2 things, why some of the banking data is inappropriate, and then if you can also touch on the social media data angle. Why is that, why would that be wrong to use that?
Sure, I think I can do that quickly. So as Ann pointed out, there's a lot of sort of exciting opportunity with the banking data. It could be used to capture regular payments like rent and utilities. You can use it to capture, overdraft and bounce checks, those kinds of things. So that's great. Where we'd have to be careful is when we start looking at data about how and where people spend their money, because those kinds of indicators can be proxies for race, ethnicity, for neighborhood, for gender, for lots of things that we want to be very careful of. Some of the same issues would apply in the case of this, social media data, for example. There have been quite a few studies as Ann also mentioned, that have shown that some social media kinds of activity are predictive. But in China, for example, people are assigned a social score, based on the people that they associate with as a sort of measure of trustworthiness. Well, it may work in China, but that's not going to fly very well here in the United States, where we so highly value individual privacy. And actually, we would be in a lot of trouble. Ann and I have many of the same friends. So if we were to adopt this here, I think we would be in big trouble. Because we highly value privacy. We have lots of privacy protections from a legal perspective. And so that's not something that we would want to get into. There are also disparate impact issues related to that as well.
Thank you. So, Anne, you've got about a minute or two.
A minute. I'll use a minute. So we have basically 4 recommendations for policy.
Jump in.
We think the scale is useful, but one is legislative efforts to encourage the reporting of traditional credit proxies should be encouraged and strengthened, that currently, as I said, don't preempt existing laws. Second, bank regulators should continue their efforts, we'll hear about them in a minute, to explore the use of banking data. But we believe that it should be very careful in terms of the types of banking data that you should be able to use because of privacy and other concerns. And sort of as a corollary to that, we also think that these large-scale data aggregators that are out there should be subject to the same privacy and transparency standards as credit bureaus. And not, to my knowledge, they're not today. And then the last is, I think that in this era of big data, Congress should really look at existing FCRA and existing fair lending laws to see if there are other kinds of restrictions that should be put on the use of data.
Okay, perfect. Well, thank you so much. I really appreciate your time. I think we do have like 1 minute. If you can also answer this one about, is there a reason to prohibit the collection of certain types of data?
In a way, that's what they tried to do in Europe with its privacy laws. There was a book by Michael Chertoff, am I saying his name right, that argued you can never really know how data can be used. And certainly, like a lot of the social media data has been used in advertising. And he argues that it's better to control the use as opposed to the collection of the data, because you really never know. And that is probably easier as well. But that's the approach of fair housing laws, basically, and FCRA. And we think that that is a very practical way to proceed. And in particular, maybe examine the use of certain types of social data for fair lending laws, whether or not they need to be expanded.
Mm-hmm. Well, thank you both so much, Ian and Vanessa. That was excellent information. I learned a lot from your presentation myself. So I appreciate your time. And we're ready to move on to our second panel. And we'll jump right in because we've got more great experts for you. As if that wasn't enough, we have Phil Bracken with Vantage Score, Kelly Thompson Cochran with FinReg Lab, and Barry Whitus from the Office of the Comptroller of the Currency. So welcome all 3 of you. And I am eager to hear about what you guys are doing and what you can share with us on this important issue. So let's start with you, Phil. Tell us a little bit about Vantage Score and the kind of work it's doing around alternative credit, please.
Thank you, Michelle. And first, thanks to the National Association of Realtors and also to Vanessa Perry and Ann Schneer for the wonderful work they've done on this research project. Vantage Score Solutions is a 15-year-old company that was started to create competition in the credit score model development arena. I'm thrilled to report that a renowned research firm, Oliver Wyman, in the past couple of years produced a report that said there were nearly 12.3 billion uses of Vantage Score in the credit markets for credit card, auto, student loan, et cetera. And nearly 2,200 lenders in America, when given the free market choice to select a credit score model to use, they selected VantageScore. Very little of that was in the mortgage sector. As you know, many of you know, the GSEs mandate the use of a traditional legacy credit scoring model that is not VantageScore. But all of that is about to change as the United States Congress recently passed Senate Bill 2155 that became law, and it includes a credit score competition mandate. We have filed our application with the GSEs for approval of our credit scoring model. We're anxiously anticipating that the first phase of our credit score model approval will be completed by this summer. And why is all that important to all of you? Just a point of reference, many of you have seen the Harvard Joint Center for Housing's demographic surveys that tell us that nearly 80% of the new household formation in America will be people of color. And we've seen that many of those people are the underserved population. In fact, lots of them are described as credit invisibles in many of the trade magazines, and certainly in recent congressional hearings, there's a lot of insight about credit invisibles. I might just say those people that are described as credit invisibles to many are certainly not credit invisible to us. VantageScore's model can provide a credit score for about 40 million consumers today, just using our traditional sources of machine learning and trended data and other analyses. I might add, without relaxing standards. And of those 40 million consumers, nearly 10 million of them would have a score of about 620 or up, and they would therefore be either mortgage eligible now or sometime in the near future. And of those, about 2.4 million would be African American or Hispanic. So we are anxiously evaluating creative solutions, exploring the use of alternative data, and certainly consumer permission data to either provide enhancement to our model and or provide solutions to the marketplace, especially for aspiring homeowners and to the realtors and lenders and home builders of America. So we're anxious about the opportunity to advance the cause for all of those constituents.
Excellent, thank you. So it sounds like alternative credit scoring is kind of already happening, or you've got that in place. But who are the investors in mortgages that would use alternative credit? Is there an interest in that on investor part or concerns?
Well, I might just say, Michelle, that historically over the past 40 or so years, many investors have been interested in all sources of data that can help enhance the determination of creditworthiness of consumers. Years and years ago, when we underwrote mortgages for consumers, we included information reports from the landlords and from utility companies on the payment habits of the consumer. So investors worldwide would love to see more data, more transparency, more information that would give them a better opportunity to determine creditworthiness. So it's the current sources and use and new technology advancements give us more opportunity to use it. I might just put a frame of reference here that the alternative sources of data, like as Ann and Vanessa mentioned, rent, utilities, telephone, et cetera, are rarely reported to the credit bureaus, and most current models that are used for credit score model development utilize the information in the credit report. So we're going to have to find other ways to get access to that data, as they mentioned before, Ann and Vanessa, about the use of consumer permission data and getting access to bank accounts, et cetera.
Okay, thank you. So I want to touch for a second just on the issue of overlays that lenders place on borrowers. Has that created a new kind of redlining effect that you've seen at all?
Well, it's an interesting question, and lenders many times, have had to impose overlays where there are risks that geographical and other kinds of risks with job market losses in certain areas, et cetera, that might create risks that are just not normal in a traditional environment. I would say that no lender in America wants to create, or at least I don't know lenders in America that want to create imbalance and inappropriate access to credit on purpose. I think they all have trying to do the fair and responsible and equitable thing for the consumer of America. There are unfortunate circumstances where overlays do impact certain segments differently. I know from our standpoint, we are trying to level the playing field for all of those segments to deliver fair and responsible and equitable treatment and access to credit.
Great, thank you. So related to the alternative credit and credit scores in general is financial literacy. So I'm wondering if you could talk about that issue a little bit, because it seems like there are a lot of people that lack solid financial skills. So should high schools be teaching money management, or are there other programs that you think would be useful that would improve credit worthiness?
Thanks for asking that question, Michelle. The answer is yes, yes, and yes. Let me, by the way, we have tried our very best to tweak that phrase, financial literacy, to be more inclusive, to respond with financial education and empowerment. One wonderful social responsibility initiative that we've undertaken through the historical Black colleges and universities, administered through our great friends, a company called Home Free USA, the largest Black-owned homeownership preparedness and housing counseling organization. We have developed a program with them to outreach to the historically Black colleges and universities, where we're providing more education, information, mentoring, et cetera, for the scholars in those universities to educate them more about the use of credit, the aspects of credit, the credit scoring, and frankly, empowering them to be more interested in opportunities for employment in the financial services, real estate, and home building operations of America. It's a wonderful initiative, and the answer to your question is yes. We can't start early enough, and it's a really important initiative to us.
Great. Well, thank you so much, Phil. Thank you. That was really interesting. Kelly, I'm turning to you now. I have to admit that I had not heard of FinReg Lab before. And so I'm hoping I'm not the only one. I'm sure there are other people who would like to hear more about it. So tell me about your organization and what you do, and especially the work that you're doing related to alternative credit and fair lending.
Sure. Well, thanks for the question, and to the National Association of Realtors for inviting us to participate. It's a great panel. So we're a relatively new organization, so I'm still gaining name recognition. We're a nonprofit, nonpartisan research center focused on the ways that data and technology can potentially increase financial services for underserved populations. That could be consumers, small businesses, specific geographic communities as well. And we do a mix of research. So some of it is empirically based, where we're actually evaluating particular data or techniques. Some of it is market monitoring, where we're looking at developments and how different players are implementing new data and technology solutions. Doing a lot of convening and working with stakeholders in different segments of industry, advocates, research entities, and regulators to really determine what questions are most critical to determining whether particularly promising innovations can reach scale. And then also doing early stage policy analysis to help those dialogues and discussions move more quickly to resolution. One of the projects that we've done in this area that I think has gotten a lot of attention was focusing on the use of cash flow data, largely bank transaction account data, but also some other sources in credit underwriting. And I could talk more about that in a minute. But we've also in the last year been doing a number of kind of shorter research briefs looking at issues with regard to traditional credit reporting and scoring in the pandemic era, some of the challenges that consumers are facing and policy questions that are arising in that space. Going forward, we're expecting to do a brief shortly on some telecom and utility data issues, not empirical research, but more kind of market monitoring. And we're also looking at machine learning issues. I think we've touched on that a couple of times over the hour. Oftentimes, some of these scoring and underwriting algorithms are using machine learning, which is kind of more sophisticated and often more complex math to do predictiveness analysis. There are potential benefits to that, but these models are complicated. And so how do we manage concerns about transparency, about fairness risk, and so on? And so we're looking in those areas, as well as continuing to look at data issues going forward, particularly as we look at pandemic recovery. So a lot on our plate.
Yes, wow, that's a lot of projects you've got going. That's amazing. So tell me a little bit more about your studying about the use of banking data in the evaluation of credit risk.
Sure. So we worked with 6 companies that are live in the market. This was pre-pandemic, that were live in the market using different sources of cash flow data to help underwrite both consumers and small businesses. It was a range of products, different types of loan structures and so on, not mortgage, but just a really broad range and a really diverse range of companies and customer segments and so on. And so we were able to analyze the data to look at the predictiveness of the cash flow information and also often compare it to traditional credit metrics that are being derived from traditional credit reports, whether those are individual variables or traditional scores. And so we looked at several things as we did this, and the cash flow metrics vary, but they were the kinds of things like average balances, negative balance events, those kinds of things. Our sense is, as Vanessa and Ann were talking about, there are a lot of concerns about using cash flow information to go really granular on individual transactions, like where do you shop for the groceries, and people are concerned about that for many of the reasons that they raise. So this tends to be more global, global data about how the account flows are working over time. And we had several findings. The first was that the cash flow data appears to be very predictive across this really diverse set of business models and products. And there were 2 things that were interesting about it. One was that it was predictive by itself. So if you're in a situation where you don't have a traditional credit report or score metrics, you could potentially use the cash flow data by itself. We also found that it often added insight and predictiveness even for consumers who did have traditional metrics. And so that goes really importantly to some of the questions that we were talking about earlier about not just people who are unscorable, but about people who with a broad range of scores and kind of backgrounds where traditional lenders may be having challenges in kind of differentiating within score bands about who is high risk and who's low risk. So that is potentially useful for a much broader population. We also looked at inclusiveness and fairness issues. We found evidence that the companies whose data we were studying were able to reach populations who historically have probably had some challenges in accessing credit. And we also found that the predictiveness appears to hold up across different demographic groups. So rather than proxying for race, for instance, it's giving predictive value for different groups. And that's obviously hugely important. So it was really encouraging. We've continued to, monitor this space, talk to people. We have a sense that a lot of people are interested in looking at this data even more in the last year because of some of the challenges with the pandemic and the fact that people really wanting to have a deeper understanding of how households kind of balance sheets are responding to all this. So continuing to monitor this space and talk to additional people beyond the folks that we study to continue to monitor the market.
Interesting. So where do you see the major challenges for implementing some changes in credit scoring?
There's several, and I think we've touched on some of these already. The first set of challenges is for individual companies as they are vetting new data sources, new models, if they're using machine learning, those questions as well. Really understanding what value the data gives them on predictiveness and how does it work, what are the evaluation in terms of fairness and other considerations. That takes time and effort and investment. And so, individual companies are working through it different ways. There's a number of options that are being offered by scoring companies and by some of the traditional credit bureaus, different players, to help individual lenders kind of go through that process more quickly. But there's a lot of effort that goes into that first stage. But that's not really the only question. You also have to think about a couple of other things that affect people's willingness to adopt and make all of the business model changes that they have to make to adopt new underwriting and new scoring. So things like business model considerations is, what does the lender consider to be their target market? A lot of underserved populations may be looking for maybe smaller loans, or they may be slightly higher risk. Not all lenders are necessarily willing to serve that entire scope of market, so they have to make decisions about those kinds of questions about market scope. Another question, especially for smaller players, is their kind of technology ability to plug in to do kind of the analytics and to get access to the different data sources and so on. And then, as we've talked about a little bit, investors and secondary market players also often use these same scoring metrics to kind of have benchmarks that they can apply across portfolios. And so while there's great hunger and interest in solving this problem, there's also a lot of operational change that comes along with making changes. Lenders have to think not just about themselves, but about other players around them who may also be affected. And so all of those things are coming into play. There's also questions about the underlying data flows, particularly as we've been talking about, a lot of these flows involve customer permission, that some of them are flowing through different types of intermediaries that haven't traditionally been part of the kind of traditional credit information system. So that raises questions. And then customer side questions, because where a customer has to permission the data, how do they feel about that? What are the processes? What are their attitudes towards privacy and the fairness of the use? And what are kind of the process frictions that can develop? Are they connected? Do they have digital access? Underlying bank account access? All of those kinds of questions can play in. So there are a lot of pieces here. I think there's a lot of interest, and our sense is that the interest level has gotten even higher in the past year because of the pandemic, from the time that we released our third report on the cash flow project. But there's also a lot of challenges, and the pandemic in some ways does make it more complicated, because I think whether people are using traditional data or non-traditional data, we really have to think about what does it mean if households have had challenges in the past year. Is that really predictive going forward of what they may be paying, for many years over the life of a mortgage? And how do we consider those kinds of considerations? So there's a lot of moving pieces here, and that, I think, is one of the reasons why it has taken time, even though people have been working on this for more than a decade, to kind of really get momentum in the space.
Can we all just erase 2020 and skip over it? I'm sure I'm not the only person who would like to do that, but I obviously I see the challenges in that too. Yeah. So, well, thank you so much, Kelly. That was really interesting and helpful. So Barry, last but not least at all, I'm excited to have a chance to bring you into the conversation here too. So if you can start, tell us a little bit about Project Reach, what that program is, the goals, and who you're working with.
Yeah, great, and thanks very much, Michelle, and thanks to the Realtors for inviting me. So just for those of you that are not familiar with the household word OCC, it's the Office of the Comptroller of the Currency. We're the bureau within the U.S. Treasury Department that supervises national banks and federal savings associations. Our Project Reach was launched last July. It stands for the Roundtable for Economic Access and Change. And what it does is it brings together leaders of banks, civil rights, and community organizations, as well as technology innovators and other businesses, to exchange ideas, identify solutions that help promote full, fair, and equal participation in the financial system. Something that we've all spoken about today, and something that's very much integral to the mission of the OCC. Our role with Project Reach is to facilitate a dialogue and collaboration, contributing our expertise on safety and soundness, consumer protection, fair treatment, and fair access questions. We have nationally recognized community and consumer organizations who are intimately familiar with the needs of minority communities that are key participants, including the Urban League, the NAACP, and Unidos US, just to name a few. These community leaders are working with the financial leaders through our 4 Project Reach work streams to identify and eliminate obstacles to credit for consumers in order to, 1, expand accessible homeownership for minority homebuyers, and that's the work stream that I lead. 2, to enhance minority and small business opportunities. 3, to reinvigorate minority banks that often serve neglected communities. And then 4, to help provide financial access for the credit invisibles, which we'll be speaking about a little bit more in just a moment. Our Project Reach Credit Invisibles work is focused, as we've discussed earlier, on whether consumer permissioned alternative data can be identified and fairly used by banks and other traditional lenders to expand financial access and to improve the speed and accuracy of credit underwriting. This Project Reach work stream on the credit invisibles is comprised of 5 of the largest banks, the civil rights groups that I mentioned and others, several fintechs, and a few data aggregators. And they're focused on 1, identifying, obtaining, and analyzing alternative consumer data, such as average account balance, cash flow in transaction accounts, or timely and regular payments for non-credit bills like rent, cell phones, or utilities that may appear in bank accounts, or from other alternative sources that retain that kind of data. And 2, establishing alternative credit scoring methods that regulators recognize as a safe and fair tool to assist underwriting and helping credit invisible people. We've made really good progress through the bringing together of this diverse group of players, each bring a very strong interest in solving this problem. And very much like the multilateral process in developing the COVID vaccine, having the government with a seat at the table allows us to provide real-time feedback to questions and issues that come up. So for those of you that want to follow what we're doing in Project Reach in the credit invisible space, you can visit our Project Reach webpage on occ.gov, as well as sign up for our listserv or our Twitter feed at USOCC.
Thank you. Okay. So what is the OCC doing to kind of encourage some changes with alternative credit? Project Reach is the main thing that you're doing, or are there other things that you're doing also?
Yes, I think the most important thing that we at the OCC and the other federal financial regulators can do is to be as very clear as possible about the regulatory expectations for a bank looking to incorporate these non-credit factors in their underwriting. Using alternative data in underwriting carries risks for banks and consumers. Banks face risks if consumers choose only to disclose positive data, leaving lenders with too rosy a picture of their creditworthiness. If, for example, late payments are not disclosed. And consumers, as has been discussed by some of the earlier panelists, can be harmed by the use of data that doesn't really have an understandable relationship to creditworthiness, such as data on social media or internet browser activity. So in order to provide greater clarity on these points, the agencies recently issued a joint statement on the use of alternative data in credit underwriting, which does highlight the risks and benefits to banks and consumers of using the alternative data. The statement recognizes that responsible uses of alternative credit data may improve the speed and accuracy of credit underwriting and help credit invisible consumers obtain credit. The joint statement also references the relevant consumer protection laws and regulations applicable to the use of alternative data in credit underwriting. So as time goes on, I believe that we will learn more by being at the table with the various actors that are participants in Project Reach. And it's very possible that we'll continue to see additional guidance come out as we learn more about this as we're working the issues real time.
Great. Okay. Thank you. So Project Reach also has some of the organizations are nonprofit financial literacy organizations. What can you tell me a little bit about those and some of the initiatives that you think may be helpful to some people in the audience, to learn about what they can bring to their own communities on that level?
Yeah, absolutely. So Project Reach has at the national level organizations such as Operation Hope, Home for USC, who Phil mentioned a moment ago, Unidos US, the National Urban League, the National Association of Real Estate Brokers, and ID, all of whom for decades have supported, guided, educated consumers facing challenges with credit access. And as trusted community advocates, they're really essential to identifying fair and appropriate ways to advance and expand access and inclusion, and then educate the millions of consumers who may benefit from the efforts of Project Reach. One of the things that really has been quite successful is we've seen as the regulator of banks is that they're leveraging these housing counseling organizations, one to provide for referrals of those who have been denied credit turn downs that may have the potential to be a home buyer in the future, but are not credit eligible right now. As we've discussed, there's a very considerable number of these individuals who have an established payment history on perhaps non-credit obligations, the thin files, but because of the way that our credit scoring system works traditionally with FICO score, the lower versions, the earlier versions of FICO, it's not adequately picking up people who have that established history on non-credit obligations. So by making referrals for particularly these thin file borrowers to housing counseling groups, these groups can help people to perhaps utilize some of the tools that have been discussed earlier today. The FICO Boost, I believe, was mentioned, where consumers can actually permission certain data. It's not intuitive, I would have to say, having looked at it myself. It probably does for a less sophisticated buyer. Benefit from the help of having a financial coach, a financial counseling organization. So certainly these organizations need financial support, and some of the banks that we supervise provide that to these individuals. These organizations also receive grants and other financial support from banks that are looking to make inroads into minority markets that they may not have the penetration that they would like. So, Home for USA in particular in the Washington, D.C. area, which I'm very familiar with, does outreach into the minority community, particularly working through the Black churches in the Washington area to do seminars on how to qualify to purchase a home and offering training and homebuyer education sessions that get a person ready to make application to apply for a mortgage. And so those are a couple examples of initiatives that I'm familiar with that I think have a lot of promise and certainly could expand a lot more to reach these markets that we're trying to reach.
Excellent. Well, we are just about out of time, and I think we could probably talk about this for another hour or two at least. Really interesting and great to hear about so much progress being made in this area. And the one thing is, I was thinking just now as you were talking about, great to do all this outreach and to educate people. We just need more houses for them to buy. I feel like this is going to be great. We'll add more buyer demand. So, but that's a topic for another day. But as far as opening up the credit box for more people, I think that's great and really interesting to learn about how it can be done. So I look forward to hearing more about everybody's research on this. Thank you so much, Kelly and Phil and Barry. Thank you. And Anne and Vanessa earlier. Thank you too. And thank you to everybody who attended today. I appreciate the interest in the topic, and thank you. And thanks to the National Association of Realtors for sponsoring it.